in a good position here. And the last thing I want to say is, don't worry, I know you all have been wondering whether Germany has a government or will ever get one. We have been wondering a bit too. We have had really a rather unique situation with what we call coalition negotiations going on for much longer than they usually do. I'm not going to tell you why this is the case. That's very special German stuff, and you might not be interested in that. But the fact is, and for those of you who don't know, the negotiations have come to an end. There is a draft agreement on what we call grand coalition between the two big parties, and at the moment still ongoing is sort of a referendum, or how do you call it here in California, initiative process where people do vote on a specific proposal. So in Germany at the moment, the members of one of the parties who are willing to enter into this coalition are voting on that proposal. And the plan is that by the weekend we will know what the result is. And if the members of that party decide to accept the proposal for an agreement, then we will have a new government, and next week then our parliament will have its last week before they go into the holiday recess, and then Mrs. Merkel will be elected chancellor next week. And also the government will be known, the ministers, and what I very much hope, and I'm sure you too, is that Germany will stay competitive, will try to keep ahead, and will also be supporting entrepreneurship as has been done by the last government. That's probably, in my view, the most interesting thing, whether we will keep up to look at the Silicon Valley and at startup entrepreneurs as a role model, which is also important for our economy. But we will know more about that, and even if we don't, even if we get back into our old habits and just look at big companies, big industry, Germany is strong. The parties that are in discussion now about a government, they're both very reasonable parties. They won't do anything weird. So, sorry to say, you will have to stay to reckon with us. But so that I can say next year I was right again. 2014 is going to be a terrific year. The euro is going to be stronger at the end of next year than this year. Mark my words. And with this, I hand the floor over to our analyst. Thank you very much for coming and joining me.
I guess we have the answer. We're done. Well, welcome everybody to our annual Financial Outlook event. Thank you, Consul Roten, for having us here, for hosting us. Thank you, Caroline. Where's Caroline? There she is. And thank you everybody for coming. This is always an interesting event. This is the 10th anniversary of this event. So we have done this quite some times. And it also has always been sold out. So there are some empty chairs. That doesn't mean it's not sold out, but if you want, you can sit down. So. It's always an interesting event in good times as well as in bad times. I remember the event in 2008. It was a more sad and somber atmosphere, but it certainly is a fun event, especially if the economy is looking up. And 2013 was a great year. Economy has continued to improve in the US, in Asia, in Europe, I guess the good news is Europe has not blown up, so knock on wood, and thank you to the German economy, and thank you, Consul Roten, for that.
My pleasure. We worked hard.
2013 saw also new heights for the S&P 500. We are at 1800 now. That's more than back in the good old days, .com 2000. It's also more than in 2007 in the good old mortgage-backed security days. So again, knock on wood. 2013 was a good year for IPOs, for initial public offerings in the US. It wasn't as busy as back in the .com era. Maybe that's a good thing, but it had some big IPOs. Twitter went public. A number of other tech companies went public. Last not least, Facebook went public last year, but this year they're above their issue price, so all the Facebook employees are happy, all the option holders are happy, and I think the realtors down in Atherton are also very happy about that. 2013 also saw a record participation from corporations in venture capital, and we'll be talking a little bit more about that tonight. So in the second quarter 2013, 25% of deals, venture capital deals, had corporate participation. It had been traditionally 7-8%, so 25% is pretty high. So about 1.7 billion were invested in 126 deals. This is second quarter, I think third quarter, they're still counting those numbers. But maybe you can tell us more about that. We always try in this event to capture current developments, so we will be talking about corporate venture capital tonight. We have an excellent panel here, some of the most active corporate venture capital investors. I'm very grateful that they're spending their time tonight with us. Corporate venture capital has been busy this year, so everybody tries to close that last deal in the last weeks of December. So thanks for being here with us. The panel will introduce themselves. That makes it easier for me and keeps me from misrepresenting anything. I then will kick off with some initial questions. We also want to debunk some myths about corporate venture capital tonight, so we will have a round of Mythbusters. And then we will open it up for the forum and for questions from the audience.
Thanks, Gunter. So my name is Thorsten. I'm with T Venture, the venture capital arm of Deutsche Telekom. We're around since '97, probably one of the older corporate venture guys. I think Intel is even older. Yeah. But we have a so-called evergreen fund. That means we don't have a certain fund runtime. We had every 2 to 3 years we had about 250 million euros. And right now we still have about $1.2 billion under management. About 40% of the investments are in the US and 60% are in Germany and Israel and the rest of Europe. So main geographies. We always invest in infrastructure, communications on one hand, and the other one big area is media and consumer business. And we do have to have some sort of story around Deutsche Telekom. We don't need a business unit to sign off right away, even though we have 70% of our portfolio companies have commercial contracts with our investments. But we can invest very early from a seed stage up to a mezzanine DEF round. And we do anything between $250,000 up to 40 million. So very large range. And I wouldn't say stage agnostic because that always sounds like I don't care about the stage. I actually do care a lot about the stage because of the different valuations, but I'm sure we'll talk about that later. And I joined T Venture in 2010 coming from my own fund that I was running over on the East Coast.
Thank you. So my name is Bjoern Heinz. I represent BASF Venture Capital. In case you might not know, BASF is the world's largest chemical company with global operations ranging from oil and gas to plant biotechnology, so everything in between basically. BASF's corporate venture fund was established 12 years ago, so we're also quite a while in the business already. As compared to what Thorsten just said, our fund has a more humble size. We are 175 million euro under management, so a bit more than $200 million. We have investments in young companies with a focus on chemistry and materials, on biotechnology, with a very strict strategic mandate. And I think Günther will later in the discussion elaborate a bit more on this, the differences. And so we have a very strong tie between the young companies and the actual operations of BASF. So I'm representing, together with a colleague of mine, BASF Venture Capital here in California. We have 3 colleagues in the US in total. And of course we see the Silicon Valley here as an extremely amazing place to do what we do and to tap into this amazing pool of knowledge and innovation.
Thank you. I'm Anders Ranum. I'm at SAP Ventures. We've been around 17 years, so I think we're actually a pretty seasoned group of capital ventures companies represented there on the panel. SAP Ventures started off doing off-balance sheet investments from SAP, but in 2011 spun out as a separate legal entity. So we actually have a classical LP-GP relationship with SAP proper. So it is SAP's money that we're still investing, so they are a sole limited partner in our funds. We have $1.4 billion under active management. We have about 120 investments over the lifetime of the company. Right now we have about 40 investments active, predominantly in the US, probably around 20% outside of the US. So all our funds are actually global in nature. We also do a little bit of fund-to-fund that started a little bit with that last year, where we are actually, instead of doing early stage investing, we're actually investing in early stage fund managers around the world. So we are limited partners in for example, Early Bird in Germany, Pointland Capital in Berlin. So we're actually investing in fund managers as well.
Good night. My name is Marlon Nichols, and I represent Intel Capital. Before I get into the introduction, I'd like to ask you guys a few questions, just so I know who's in the room. So, just with a raise of hands, how many of you are entrepreneurs? Okay. And how many investors in the room? Bankers?
5.
Lawyers? Okay. Thanks, just helpful. I can kind of tailor the conversation. So Intel Capital is the global investing arm, both equity and M&A for Intel Corporation. We're global, so we operate in every corner of the world. We put about anywhere between $300 to $500 million to work every year. We have an active portfolio of about 400 and I think it's somewhere around 480 companies right now. We are stage agnostic. I focus on the seed stage in particular around our ultrabook and perceptual computing business sector. What else can I tell you about this? We tend to pick winners. So just this year alone, we've had 5 IPOs and 22 M&As. So we're pretty happy about that. And we're right on, we're in stride in terms of being able to spend in our usual range of 300 to 500 million.
So Marlon, let's start with you. So how was last year and how is next year for you?
So I wrote down some stats. So last year was pretty good, or this year was pretty good. As I mentioned, we're right within our range of 300 to 500 million invested. I mentioned the 5 IPOs and 22 M&A transactions. We're active really all around the world. 52% of our deals came out of North America. And then considering Europe, Israel, and Russia made up another 21%. So pretty active there too. But all in all, it's pretty good year. IPO market seems to have picked up. We're happy about that. I mentioned a bunch about the M&A transactions, but companies like Intel and HP and Apple and a bunch of other companies have been hoarding cash for a while and we're looking and still are looking spend capital to be competitive, and that's what we're seeing. So, pretty good year.
Sure. Thanks, Steve.
Next year, yeah, they want.
Don't expect. Yeah, I mean, I expect more of the same, right? So we've seen, you mentioned Twitter, and we've seen what's happened with that. One of our companies, Box.net, is looking at an IPO as well. Don't see that market drying up anytime soon. You mentioned that the euro is performing fairly well. So is the U.S. dollar in our economy in general. So I don't see much of a slowdown. I actually see things getting a lot better in terms of the venture space. I will say though, the best time for venture investors to invest are in more so down economies, because the price tags that come with some of these deals are way more attractive. Gives you a lot more upside on the back end. But in terms of managing your current portfolio and exiting that portfolio, you obviously prefer the upward economy.
Sure. 2013 was actually a really good year. We had about 13 exits, predominantly IPOs. I think we'll see a lot more of that coming in 2014 as well. We are co-investors with Intel and Box. We know that we have a handful of companies already that are sort of working in 2014 and getting ready to go out. So the fundamentals of that side is looking really, really good. We have the returns that we got. Also because the investments were made at at cheaper times, actually turned out to be a pretty good year for us. So that's one of the worries that we have going forward. S&P Ventures is predominantly expansion stage focused, which means we put in money pretty late in a company, so we're very, very sensitive to valuations. So that's obviously something that concerns us going into 2014. That is more of a indication that the economy or money at large is readily available. But as investors, that makes us worried because it's really, really hard to kind of drive above normal returns when the valuations are really, really high. But if it continues like what it did in 2013, we'll be very happy in 2014.
So I think in 2013 we saw some interesting developments regarding the fund investments we made, and this is how BASF Venture Capital started out. And I think it's a common scheme among corporates to start with fund investments to get reputation in the market, to develop a deal flow. And the companies in our funds, they're coming of age. They're a couple of IPOs this year. We're quite happy about what we see there. And in terms of investments, the numbers are not so high this year. We made one investment actually, which is still in stealth mode. The negotiations are still going on there, and but we have been extremely active. We typically look at 900 companies a year, so the deal flow is definitely there. Yet we, as a materials company, often see that this is a very, very thorough process to really develop new chemicals, new products, and bring them into the market to upscale them. And this is, of course, taking an extreme amount of the technical due diligence. And I think 2014, in this context, we'll see more deals from our side, because we have a couple of things in the pipeline which are pretty interesting. And so I'm pretty much looking forward to that.
I can just add to that. 2013 was a great year, and we had 2 IPOs, 4 M&As, a large number actually of M&As if you look at the market. We also had a lot of M&As, IPOs in 2012, the year before, and I've got 4 IPOs right now in my portfolio that we're talking about. Bernhard, my colleague here in the US, has another 2, I think, or 3 by now. It's a race to the exit. Which is worrisome. It's a workload that is very difficult to handle for us. It's a lot of work too, if you think about the legal aspects of it as well, and litigations that usually pop up, and people who start suing you in this time when they see, oh, someone's preparing an IPO, great, right? So finally I can get some money out of that. But 2013 has been a very, very good year. 2014, I'm very cautious. So we had a bull run for 5 years now, for us at least, right? So we started really investing heavily since 2009. when the market was down, and we spent a whole lot of money then, which was great. By now, the later stage round, the C round, the B round valuations, the medians, are now on the level of the 2009 C round. So like completely off, right? Like we have a huge valuation gap there. And that's why we really slowed down this year with new investments. That said, we have 100 investments that are active, so we better exit those right now. The other thing that I'm very cautious about in 2014 is the missing mid-market. And I'm talking about public companies mid-market. So these are the companies that have $1 to $5 billion in revenue. And there's a real problem there right now, because these have been traditionally the buyers of companies in M&A transactions. And right now we see for these hyper-growth companies that we have that grow like 100% revenue growth year over year, right? We see valuations in the exit side of 10, 12, 14x on the revenue. Now, if I'm making $100 million revenue, and I'm exiting this company for $1 billion, that's what I expect on an M&A transaction, then the mid-market can't pay that, because who's going to invest off the balance sheet of the top, right, $1 billion? That's not going to happen. And you can't have a stock transfer either there. So the mid-market is completely empty, and that's really worrisome, because early exits are missing, the mid-stage exits are missing, the M&A transactions are missing, but these people have lots of cash. So I hope this is going to recover in 2014 a little bit. That's my hope, because it's really scary if you have 30% average growth rate on the stock, like for year after year after year after year. So maybe it's a good time to raise a fund right now, because maybe 2015 is the end of the growth phase, and then you can invest cheap again.
I had requests for rosy forecasts, so let's keep that in mind. So for the entrepreneurs in the room, so how should they work with you? How should they approach you? And then, so why should they work with a corporate VC in the first place? Kind of what do you bring to the table that a normal VC does not bring to the table?
So we're very fortunate at Deutsche Telekom to have a very strong partner organization, and Thomas is actually here. And
I didn't pay for this.
And I think there are usually like three aspects why people come to us. A, we're a very strong financial investor, so we don't really care about how many synergies are in this year or next year or what the percentage is. But what we really care about is the performance, and we're very hands-on. So all of us have operational background, and for Cypher Cloud I programmed the JBoss connector. I did the negotiations on the TomTom deal with Streetlight Data. So I'm very active with my companies, which is troublesome if you have many exits to work on, right? But so people come to us for hands-on help. So that's not that different actually from traditional VCs. The thing that is different is that A, we don't need to exit our fund. That means I invested into Scorpios, where I know is not going to be a product ready in the next 7 years. They're going to have a product ready maybe in 7 years, so the exit is maybe in 15. I don't care, right? That's a long time frame to invest. Very few other funds can actually do that, because they need to show some returns, right, and valuation growth. And the second part is the brand awareness. So Cypher Cloud, as an example, they do encryption services for public cloud services, right? There were a 3-people startup. The Bank of Canada calls and says, can we really trust this 3-people startup? I mean, can we really use the software to encrypt all our data? And there's 3 guys in the garage in the Silicon Valley. And I said to the CISO of the Bank of Canada, just call up the CTO of Deutsche Telekom and the group security office. And this is a European, German, regulated telco of German engineers. And just ask them if it's safe to use it, because they put their stamp of approval on it. And said, okay, yeah, the Germans, okay. I understand. So there is a brand, right? So everything in automotive and systems and engineering, there's a very strong brand awareness of the Germans, of the Deutsche Telekom. And I think that really helps our companies.
Yeah, thanks for mentioning brand. If you are active in the chemicals and materials space, BASF is a name, and with more than 140 years of experience now. And I think what we can bring to the table, since I mentioned before that we are a very strategic investor, this means the company we have to invest in needs to have a champion in our existing business to say this company opens a window of technology for us. We really want to do something with them. And so, for example, if a young company comes to us with a vial full of a chemical which is maybe as big as Gunter's glass there, and say this is the greatest thing, we definitely need this. And we say, yeah, our first customer will probably need as much stuff as fits into this room here. So how can you gonna make this? And then you see their faces and oh my goodness, yeah. So how are we gonna make this? So I just want to say that this is in the materials industry a very common problem. How do I make it to big scale? Yeah? How can we make a world scale plant out of something and really distribute this globally? And I mean, I think this is really something which BASF has proven in the past that we can do this, and there we can help with our engineering and upscaling competency here a lot. We can also help companies in finding markets and tapping into our customer base when they start off with their product. There are some interesting examples in the field of, for example, construction chemistry. We have an interesting investment there where you want to use CO2, which nobody really wants, to make construction material, build houses out of CO2. Wouldn't that be great? So things like this where we can really contribute and bring something to the table as a materials a company who knows how to run big operations, and this I think is in this space where we are specifically operating in also a key point.
Sure. So I think there was a couple of questions in there. One was how should entrepreneurs approach us? SAP Ventures, we are looking for dominant players in emerging markets. So when you start reaching significant sort of revenue and you understand how you're going to scale, if I give you 20 more million or you raise 100 million. The day when you understand sort of how to put that money to work, that would be a good point to reach out to us. Why should you work with us? Brand has been mentioned. We focus on a couple of things. We are very expansion focused. So when you're looking at taking your company either from Europe or Asia to Europe, US or other parts of the market, we think they're a phenomenal partner in helping you understand local market dynamics and get situated there. So when you look at sort of LinkedIn, we were investors in LinkedIn when they want to go into India. We actually actively worked with them to help them thoroughly understand the market dynamics of India. We can do that because not only have we been operating for a long time ourselves, but also because of SAP's relationships and connections. SAP has about 152 managing directors, so there's hardly any country in the world that you couldn't get some sort of local dynamic and insights into if you wouldn't want to. Or we are very active in 26 industries, so if you want to understand something, we think that we have access and ways to get that. That being said, SAP Ventures is a purely financially motivated team. So the only KPI that we are held accountable for is to return a decent amount of money to SAP. So that is the lifeblood for what we do. So we don't work actively with SAP to see if there's an alignment and fit with sort of businesses that they're doing. The other thing what we're very focused on is unit economics. So we spend a lot of time on analytics. We help your CFO, your sales organizations, truly understanding how to be effective, how to kind of squeeze that extra resource out of the teams and the money that you put to work. So that's sort of when we helped teams, same with sort of I think Box when they went to London, we worked actively with them to kind of establish the headquarters in Europe and so forth. So we feel that we can add a lot of value there because of our own experiences as well as the platform and the partner in the SAP ecosystem that they're associated with.
So how to get in touch? A couple ways, right? The best way is to get referred. So if you know another investor, an accelerator, an angel, another entrepreneur that we've worked with in the past, best to connect with them because we're going to prioritize their emails or their phone calls, right? You can also obviously reach out blindly through our website or LinkedIn or Twitter or any of those channels. When is it ever too early? Because we're stage agnostic, it almost is never too early. I will say, except for our really hard sciences, it's very rare that we'll invest in a concept and just an idea. So from if you're thinking software or mobile or internet, we love to see at least a working prototype. And if we're talking about internet, we love to see you put something out there and see that your target audience is actually interested in it, right? So traction is a big indicator for us there. In terms of how we add value, we like to describe Intel Capital by sort of like a Venn diagram, right? So on one side, one circle over here, you have strategic investors, right? That are really focused on finding opportunities that will better their business, right? And then on this circle over here, you have purely financial investors that are basically measured on exits and IRR and things like that. We kind of sit in the middle and bridge the gap. So all of our investors are incentivized by returns, right? So all our bonuses and things like that are paid out by how well our companies perform. So when we're picking companies, we're looking at the potential of those companies in terms of being able to generate revenue and being successful. On the other side, we're also interested in providing strategic value for Intel Corporation. And there's a scale there, right? So on one end of that scale, we're investing in companies today that can work with Intel Corporation today. They can partner on something today and go to market on something. That's one end. On the other end, I don't know how many of you know this, but we're in just about every business you can think of. And so in order to do that, you've got to do a lot of ecosystem development. So a good portion of our early stage deals, they're about helping to build an ecosystem that Intel plans to play in. So we're a little bit in both worlds, and it served us pretty well. In terms of adding value, there's a lot that we do there. We host our global summit. It's our flagship event every year. We invite certain venture partners that we work closely with, and then CIOs from probably the top 100 companies in the world. Then we invite our portfolio companies and encourage them and facilitate meetings and introductions. So by the end of the 2 or 3 days, our portfolio companies are talking about next steps in cultivating deals with some of these really large organizations. One way that we add value. Another way that we add value is we host these things called Intel Technology Days. And this is where we would bring in, say, a BASF or a Google or a Turner or a Comcast or one of these companies that's looking to fill some void in their ecosystem. And we fill the room with, we'll bring like 4 or 5 of our portfolio companies in at a time that can address this problem from a different angle. And they spend a day talking about that company's challenge as well as the solutions that our portfolio companies bring. And usually, at minimum, there's a second conversation that comes out of that. Often, it turns into a deal. An example of that is one of the companies that I was a part of investing in, a company called Elastic Box. Through this process, we were able to introduce them to Netflix, this was a seed stage company, right? And Netflix, they're now in partnership with Netflix. They're their largest customer. And through that, because of that relationship, that partnership, they're now able to land a lot more bigger customers. The one other thing I'll add is that in addition to our investors, and there are about 50 of us worldwide, we have a business development group within Intel Capital. And their sole purpose in life is to go out and find companies for our portfolio companies to work with. That's it. So we add a lot of value, and it's mainly by activating that machine that is Intel Corporation and the many connections that brings.
So I think you already talked a little bit about that, but so what's in it for the corporation? Why are they doing it? I think SAP is in it for the money, right?
For Intel, you mean? Is that
I
what
think
you're...
we touched a little bit on that.
Yeah.
Why are they spending all this money?
Yeah. So there could be gaps in a technology that we want to fill, right? So we're finding companies that they can partner with to do that. Again, they could be looking to enter into a new space or create a new space, which is a part of what I'm doing now. in the perceptual computing sector. And there aren't mature companies in the perceptual computing sector. So we're basically building up that market. 3D printing, 3D scanning. We're doing a lot of investing around there. Right? It's not a mature market. We're building an ecosystem. And then obviously, we want to see that some return, some financial return on the investment. Right? It's not a philanthropic goal effort. Right? So.
Sure. So we don't spend any money, we make money for SAP, so that's our job. For SAP, very innovatively from the very early days, they said, hey, we want to have unfiltered channel of innovation. So we want to understand what happens, right? So we don't invest outside of enterprise software and the infrastructure space. So it's very sort of relevant in the horizon to SAP with the spaces that we operate in. So whether it is fundamental shifts in the business model, so the time when we started investing in open source companies, probably number 2 after Intel Capital as far as number of deals done in that space, SAP did not have an open source strategy. But then this was already fundamentally large companies emerging on the horizon like MySQL and Red Hat and MuleSoft and Jasper and some of these companies that are real companies that are built with that kind of business model. So when so we help SAP understand, or they can work with portfolio companies, or what is it that we think as a market impact this is going to have. So we give them sort of windows into these changes. Same thing happened 6-7 years ago. The SaaS-based business model started evolving. Again, SAP, classical license maintenance, probably the world's greatest company when it came to that model. But the world is shifting, so they get some sort of a macro level view of what that looks like, and try to understand from our point of view why we are excited as investors. So we're not trying to be smarter than the rest of the world. We're just picking up on the trends that are happening anyway from sort of seed investments in emerging business models.
Yeah, what's in for us? I think we have a very long tradition of our own strong research. Yeah, I think the Haber-Bosch system, Haber-Bosch reaction is 100 years in 2013. So which is always BASF research is quite proud of themselves, but there's so much we don't figure out. Yeah, we need other people to figure this out. So I think corporate our strategic venture capital arm is a tool in the toolbox to do innovation, to access this know-how, which is out there, which we do not have ourselves, or which we this time didn't figure out ourselves. Yeah, so I think this is a very, very important point. We have financial targets, this is for sure, but I think the overlying principle is to generate value in terms of innovation. Bring value to the company, and we see that this becomes more and more difficult. For example, you just mentioned one interesting example is 3D printing. Yeah? This probably can revolutionize the way manufacturing is done, but we are at an intersection of different industries. You're working on software solutions, you're working on IT problems, and we are working on materials. But this all has to come together if we want to make this work. Biotechnology is another field. I recently visited a company. They are synthesizing from scratch genes on a silicon chip. So they're making use of semiconductor technologies to introduce them into biotechnology. That's amazing. That really opens up new space. But this often, these critical intersection points between different industries, they are, I think, what a startup, especially, and I said this earlier, here in this region, and can do, because the dynamics are here, and the intersection points are here.
Yeah. At T-Venture, you basically need to take the risks that a business unit operational manager can't take, because his goals and objectives are annually. Maybe he has a 2-year plan, but yes, quarterly. But there are certain risks that they can't take, that they're not supposed to take. It's in their goals and objectives not to risk the whole company, basically. But you need these external impulses. And usually there are 3 areas for corporate venture capital, and it's like use it internally to make your products better, sell it to your customers, Or, and this is I think the biggest area that we invest in, is create new markets that Deutsche Telekom sells into. And that is the intersection, that's the emerging market, that's all what already has been said, but also it's about what if our customers actually need to be made more aware. So Deutsche Telekom customers, these are like Fortune 100 companies, they're end consumers and like T-Mobile customers, right? Maybe they need to be made more aware of security problems on the mobile device, or a big corporation needs to be made aware of the NSA problems that you create if you offload half of your data in public clouds, and all of these things. So as a venture capital company, you can actually really create a gravitation around a new area, and that also means that your customers of a corporation are being made aware of this emerging trend, and that's always a very healthy thing. By definition, we have to disrupt, and that means we also disrupt Deutsche Telekom, so not everyone at Deutsche Telekom is happy about that, right? As a line manager whose job it is to sell $250,000 teleconferencing solutions, and we invest in a company that sells the same thing for $250 a month a user, right? You can see how that challenges internal business models. But quite frankly, if we don't challenge that, someone else will anyways. So it's better we challenge them and also make money out of it. But being a $100 billion company, it's hard to make a dent, even if you don't burn any. So.
All right, so let's play a round of Mythbusters. I'm going to ask you to reply to one of those myths. So corporate VCs are slow. What's the fastest you've done a deal?
6 days. And there was a seed stage deal. I knew the guy from ages. I wanted to do this deal, and Andresen joined me after I think like 4 weeks later or so, something like that. Usual time from first contract, and that's so it's all relative, right? So the usual time from first contact to an actual deal in systems and chipsets, it's about 10 months, So it's a long time depending on which area you invest in and which stage you are investing in. So it's a wide area. But, early stage A-round deals usually are done in 3 to 6 weeks.
Comment on the same?
Yes, please.
So I admire you, thank you. 6 days, that's extremely impressive. Yeah, I think we take longer. Again, material science is something which takes time, and we need typically to involve people who have a look at the Gunter's glass and what's in there, and really go to the bottom of it and then have a look.
I'm starting to wonder myself. Maybe you know something that I don't know.
No, we try to be fast, but we also try to be diligent. So.
Yeah.
Sure. I think sort of the key takeaways. I think our decision-making process is significantly faster than what it takes the lawyers to get the papers passed back and forth. Let's say 2 to 3 weeks. That would be a kind of record for us. Since we predominantly go in later. There's a lot more number crunching and interviews and sort of things like that. We have to get through. Just be sure that we're doing proper due diligence. If you're the right seed or Series A opportunity came along, we can make our minds really quickly. It's not really a voting process yet.
So a lot of the deals that we do are in the Series A, Series B space, and so for those types of deals, it's usually about a month and a half to get a deal done. The fastest I've seen a deal at that stage get done is about 2 weeks. That said, I'm focused on the seed stage arena, and I'm pioneering and championing an investment vehicle internally that where we're promising 4 weeks from first official meeting with an entrepreneur to actually wiring the money over. So we move pretty quickly and are actively looking for ways to speed that up. Legal can be
The lawyers in the audience.
It's important that they do that though, but yeah, it can slow down the process.
It's not a race, but T-Venture is pretty fast.
Early stage, right? Early stage.
So the myth is kind of semi-busted, right? It depends. How about this one? So corporate VCs will keep you from being acquired by a competitor. So how many deals have sold to Oracle? This is for hundreds. This is not for.
Yeah, well, let me just take a stab at it first. So when we make our investment decisions, it's never with kind of the roadmap for Intel Corporation to acquire a company. We're investing in this company because we think that it is the best company in this space, right? Period. And we don't put anything in our terms that say that they give Intel an upper hand in terms of negotiating an M&A transaction for itself, right? Intel can come to the table, and because, as I said, the investors are incentivized by return, we want to see the biggest amount of money being put into this company in terms of buying it. So that's definitely a myth in our case.
So we 100% align with the entrepreneurs and the founding team. We are happy to sell any company to the highest bidder. So it happens to be that SAP is not particularly acquisitive. So more our portfolio companies at any given point is acquired by an IBM or an Oracle or Salesforce. So two recent examples would be Endeca, was $1.2 billion in acquisition by Oracle. Another one of our portfolio companies was MySQL, which Oracle also picked up for north of $1 billion. So we were quite happy with Oracle.
I think the same. I can also bust this. If we would negotiate any preferential rights regarding an exit, we would lose the credibility with our co-investors and within the community. We have to be open to all different ways of exits, and we have seen that companies develop over time, maybe in a way which is very nice for the company, but not at the strategic synergy is not there anymore. This can happen. It's a normal thing. So why should we let this go?
Yeah, it's exactly the same. Many of the companies that I invest in have very, very strong commercial relationships with Vodafone. A very strong competitor in Germany, Kabel Deutschland. Really fierce competition in their own country. It has never been a problem because they know that there's a financial investment incentive. It would be stupid of me to say, no, you can't invest in this guy if they want to spend the money and make the company big and I have a big exit, So, and also, again, it's a small world that drives ecosystems, that's what I was talking about before. So if there is a big gravitation around my company, then Deutsche Telekom will profit the one way or the other if there's a whole new market that's created. And we don't acquire companies. We're really bad at this, I would say, in the past. We are a German organization. You see these acqui-hires here, where 40 people company startup is acquired for we wouldn't even know how to hire these guys, right? How to write the contracts, right? There's probably a 4 months or a legal affair involved in that. So it's just we don't have the setup yet to acquire talent internally. I think, and the other thing my current outgoing CEO, René Obermann, always said is, if you want to have a role, why buy a bakery, right? You can always buy the rolls. You don't need to buy the whole bakery for that.
So that myth is busted. And any questions from the audience? I would like to open it up. Yes?
Sorry, can I challenge you on that, what you just said? Unfortunately, I've been working for about 15 years as a lawyer in Silicon Valley, and my biggest problem is, frankly, to negotiate some of these deals, especially some of the side letters. I'm not going to name any of these companies that are right up here, but frankly, just very recently, I had a strategic investor, which is not represented here, where it took us about a month to negotiate a side letter, where they wanted to write a first refusal on the back end, And we finally got to a right of first negotiation, or an indication of interest, and also the right of first notice, which I think Intel is actually doing a great job, by the way, on that end. That's what you guys negotiate. Always, we know where you stand. But there are a lot of strategic investors that don't seem to understand what you just said, and I'm so glad what you just said is awesome, because that would be great to have in a lot of the deals that I've worked on.
Yeah, we only invited the good guys. Yes, there's a question.
Yeah, my question is, every one of you gentlemen talked about solar. What aspect of solar do you want to get involved in? Technology, the solar farms, or the inverters or things like that? Or is there something new, unique coming up in your mind?
In solar energy?
Solar, you mean solar energy? I mean, the solar is essentially, if you look at, is the solar cell technology, solar panel technology, which is really makes everything. And there's fundamental things in cell technology. You gentlemen coming from Intel, you know the semiconductors. It's part of the semiconductor business, pretty much. It's from the cell technology standpoint. But it requires very capital intensiveness. Now, where do you get the money to do that? The second thing is, if you invest in other things, there are very few pieces left in solar business where you can put money in.
I think, so we don't invest in solar energy or any clean tech that's too far away from the value chain, even though all these cell towers that you see, right, they need to have backup, and they need to have power amplifiers and all that stuff. But what is interesting about this industry is that more and more management systems for solar panels or green energy are around, and that means M2M communication, machine-to-machine communication. A lot of these have embedded SIM cards now that fire back, and that not only creates the problem of how do I communicate with all these panels, how do I know if they're still active, what's their availability, are they 80% down, are they 20% down? So that's a very interesting aspect for us, and also energy management and big data management, how to manage consumption in the grid, but not directly in solar.
Again, our perspective is from the materials side on solar. We're active in this field. We are, for example, working on a novel printing process to metallize solar cells. Solar cells are typically metallized on the front side with silver. Silver is a precious metal, it's expensive, no one wants this, it drives the cost up for solar power. Here the goal is to either replace silver or to use as little as possible. This is what we do actually together with a startup company. However, I can also tell you that after the last 2.5 years in the solar industry, placing a new technology there, it's quite a challenge, if possible at all. Yeah. If the big companies are working at, 50-60% utilization, they probably don't want a new printing technology. This is probably not their first and foremost goal. Yeah. But however, this is an extremely innovative industry. I mean, if you see, for example, how cell efficiencies have developed over the past years, it's amazing what has been done, how the cost has come down. And thin film solar is another thing. It has not, I think, really taken off yet, but we're looking at this as well. It's an interesting field, but it is difficult right now due to I think the things that happened in the past. Lots of overcapacity in the market which has been built up, but it will consolidate, and we see it as a growing industry.
Sure. So SAP's venture is predominantly software-focused investors, so we would not be looking at these type of technologies to invest in. The only thing that could be potentially interesting is actually sort of the control systems that are software enabled in the back end.
Yeah, nothing more to add.
Okay, more questions? Yes.
We would Intel invest in solar.
So we were active in the kind of sustainable energy sector. Pulled away from it mainly because of what a lot of things you've heard. Right, it's a tough industry to make money in, honestly. And as a company, I don't see us in the business units. I don't see them doing a lot of work in and around solar technology. So it's just not a strong priority for us right now.
Along those lines, what's your forecast of bridging the two green technology and the green dough that we want to make. I mean, BASF, green chemistry, virtual servers that reduce your footprint in your IT business, in telecom, maybe like energy efficiency. What's your perspective of looking at sort of like the green sector, the sustainability sort of sector of investments in 2014?
So, I mean, definitely, it's a very good point. I think this is one of the biggest trends that the value chains, the classical value chains of the chemical industry, starting from crude oil and going to whatever you have and whatever you need, is being questioned and being challenged these days. And our customers, in the consumer goods industry, they ask, can we make the diapers for the babies with a super absorber from renewable materials? Yeah, and we have announced actually a couple of collaborations in this field. One is, for example, on a chemical called butanediol with a California-based startup here. Another one is with a Dutch company on a chemistry called succinic acid. So these are a couple of things which are in the public domain, and we're working on much more because we see this as a big trend to make the use of for example, microorganisms and renewable raw materials, and to transform them to high-value chemicals. So this is a big driver for us. It's very interesting and also challenging at a time.
So the green energy has two big sides. First of all, if you look at the Deutsche Telekom network in Germany, about 80% of the energy of the whole network, like backbone up to your home delivery, 80% of the energy is actually consumed in the home. This is where your DSL device sits that accepts the DSL connection, your modem, you call it here NTVA in Germany. So this is 80% of that energy. You're thinking like, really? I mean, just think about it. All the networks, if you make that more efficient, how much energy you would actually save overall on the network. So these are the very interesting things that we're thinking about edge devices, and that's why we also invest in silicon companies and chip companies, because we think that's a big area of optical chipsets that are coming out. They're very, very energy efficient, and one of my companies has a chip that's as powerful as the A6 chipset and runs on the same battery like the iPhone for about a month without recharging. Right, and it's doing actually something. It's not just sleeping there, right? So it's doing actually calculations, but doesn't have a display. So so that's a big change there. The other aspect that I'm very interested in the green energy part is really low power consumption. I mean, everyone knows that. Oh, wouldn't it be great if my mobile device, would run actually for a week and not just a day? By the way, Blackberries, these things that were called Blackberries. Maybe someone remembers those. They actually did hold for a week, but what's very interesting is now we have these graphene displays that are coming up. And we have more and more displays everywhere, and they somehow need to communicate. So graphene displays are extremely thin displays that you can basically paste on windows or have embedded into your clothing or something like that. And in order to power these, you need extreme power efficiency, and that's where the green energy aspect actually comes in. That's very interesting. Can you power these from kinetic energy, from your body heat? How about the transmission? So all these displays are out. You need to put data on them. How do you do that? You plug cables into your, probably not. So there needs to be a wireless protocol. And that again consumes a lot of power. So we're very interested in low power Bluetooth and the next evolution of that. So the whole green part is really, I think, the next efficiency wave that I see is in the end consumer devices, because we consume so much power as end consumers. I mean, all these devices and all the chargers and all the laptops and displays and TV screens and washing machines. I mean, if you think about that, there's a huge potential there to optimize.
So I'm interested in it from a context perspective, right? So machine learning, right? The smarter these machines get, the more context that they can bring into their interaction with a human, right? So that's when I mentioned this whole perceptual computing thing. That's really what this is all about. Making these devices smarter, whether they're within your house or you're holding it in your hand or whatever, and they get smarter by understanding what's going on in the world around them. And the only way to do that is if through machine-to-machine learning. And then once they get smarter, now they can interact in a more meaningful way, and which basically makes your life a lot easier. So if you bring it back to green, right? You look at what Nest is doing, for instance, right? Learning your heating or your cooling patterns, right? And basically just automatically setting up cooling and heating your house, right? You got other companies that are trying to connect the entire home, right? And then connect that to your car and connect it to your phone. These are all interesting things, and it's the machine learning that makes it possible. Sensors and machine learning.
I don't know how far you want to go with this, but just kind of, if you look at it, right, and there's a higher concentration of data centers and so forth and so on. These are very well run units. But I spent a lot of time on looking at, how can we translate that into manufacturing and, particularly refrigeration and, these process industries. And there's a lot of startups looking at, again, using sophisticated algorithms, trying to predict if you really need that level of cooling and plant, speed today. If you understand sort of the supply chain, if you can forecast this stuff. So people are looking at that. A lot of industries out there are margin, focused. And these guys understand these days that energy and optimizing the processes and so forth is important to them. And there's a lot of smart software solutions out there that are either in the market or being developed to address those needs.
Let's move back there.
Yeah, so this may be more targeted to the SAP and the T-Venture group there, but with the whole NSA topic still being out there, and you mentioned it earlier, do you anticipate that the potential fragmentation, justified or not, of the infrastructure is going to lead to a political will to increase investment in Europe in potentially developing substitutes for essentially the American infrastructure vendors?
No. It was a yes/no question. So to explain that, I think the government in general, and by definition of stable government, always has the intent to stabilize the whole country. So if something like the NSA comes up, of course there is an interest to actually investigate this and what has happened. But is the government really the right vehicle in order to foster these? I mean, how long does it take for the European Union to come up with laws or regulations? I think this is the industries that are asked right now, right, to come up with solutions. The industry has to propose something and develop a best practice and tell their customers, part of your data was actually on Amazon and probably got looked at or not looked at. I think it's not the government's job to do these kind of things. I think that would be the wrong thing. It would be too long cycles, at least for me from a VC perspective.
So actually SAP sees an uptick of interest just because SAP runs its own data centers in Europe. But we're not looking for sort of, again, political intervention. We think that the market and the people that would care about this would be willing to kind of pay for solutions that either resided in Europe or otherwise come up with meaningful ways to sort of protect them from these incidents. So there's definitely opportunities in that space, but we're not looking again for some intervention.
Looking at end-to-end Internet of Things, or even the topics that you mentioned before, do you see a shift of entrepreneurship and innovation coming more out of Europe versus Silicon Valley and North America in the near future?
Probably not the best person to address that, but I see them coming from all over, whether they're in Southeast Asia or Europe.
But you guys mentioned the ratio before, 50%,
Sure.
28%
Sure.
in Europe. Will that stay, or will it be more balanced?
So on that topic in particular?
Overall, high-tech innovation going forward.
So I think.
Oh, sorry.
So to sort of, the perspective that we have, we look for sort of the best deals, the best opportunities, the best teams, irrespective of where you are. So obviously, if there's economic or political challenges of that region, or that makes it difficult for us to invest. So we started doing a lot of investments in India, and then the political climate changed on us. So we are no longer in control of exiting these companies. So we had the second largest internet IPO in India was just We co-invested with Sequoia in that company. Phenomenal stuff, but we are at the mercy of the Indian government for kind of exiting out of the company. These things are not something that we look favorably upon, and there's enough opportunities in other areas to pursue and deploy capital. So it's, so if we feel that there's enough deal flow sort of in favorable terms or areas, then that we'll be looking for those. Same thing can happen in Brazil. Very hard to move money out of Brazil. But phenomenal market, phenomenal people and opportunities. But again, if it's hard for us to move the money out, we will try to avoid that. But we had successful companies there as well.
So smart entrepreneurs should move to North America?
I think there's opportunities everywhere. Don't come to the US just for coming to the US sake. You should have a story for why you want to be here. But if you look at corporate M&A, probably 85% of that is done from the US. So if that is sort of part of the path of the company, then at some point you will be looking this way, right? The other thing with the US is this is the single largest, most homogeneous market. So we might believe that Europe is a homogeneous market, but it isn't, right? So if you are doing a payment processing company in Europe, each and every banking regulation, it's going to make it really, really hard for you to kind of grow this fast and understand how that's going to pan out for you. So these things are, where we can do a better job in Europe. I'm Norwegian by citizenship, so, but it's just that much easier here to kind of get traction. It's interesting if you spend some time in the startup circles, and I support a lot of government initiatives from various countries, and I talk to the Ministry of Economy. I'm talking to the Ministry of Economy from Portugal on Friday, and the lesson a company can learn here in 3 to 4 weeks, it takes easily 6 to a year, 6 months to a year to kind of go through the same learning curve. So it's really hard to compete with that when that vortex has already started spinning here.
No, I was, so generally speaking, correct. Specifically about Intel Capital, we have, and Intel Corporations, right? Corporation. We have entities around the world, and so our venture organization pretty much mirrors that. So, for instance, in Europe, we have a team in Europe, and that's our team in Europe. They function as a kind of I call it a subsidiary of Intel Capital. China, Japan, Africa, South America, etc. And those teams are going to continue to invest in those geographies, right? Because our general philosophy is that innovation happens all around the world, and we want to be a part of those top companies, period.
I want to challenge that a little bit. So my 3 last deals are actually, 2 of them were in Europe, 1 was in Israel. But I can sit here and have visibility to it. And because of today's distributions and models, frankly, I don't care where the company sits, as long as you have a global domination as far as a mindset. So if you're sitting in Israel, I don't care, right? But if you're catering to the world, then we'll get there.
So to the extent that the company is catering to the world and they're actually solving a world problem, then yes, it doesn't matter where they sit. Not all solutions are applicable throughout the world, though. So we have this saying that we play around with from time to time. You ever seen the movie Saving Private Ryan? It's kind of an old movie. Remember that first scene when they're getting off the boat and what's happening to them? They're getting capped in the head and they're basically dying. And that's what happens to a good number of companies that start somewhere else in the world and try to take that same model and bring it to the U.S. Or even companies that start in the U.S. and try to take that model to somewhere else in the world. If you don't properly understand that market, and if your product doesn't properly and effectively scale to that market, then it's not going to work. So global companies, yes. Not every company that's investment worthy is a global company.
I think there's one aspect of Germans, the systems engineering, that is very advantageous for M2M systems, right? So whenever you look at large systems that are distributed, that need to be highly engineered, you might need like a lot of different moving parts. That's usually the Germans. And unfortunately, what's also the Germans is they over-engineer it. They're going to sit around and like for 6-7 years, they're going to work out the perfect system. So I think there's something to be learned for these great minds in Europe, how to actually fail faster and how to be okay with failing. And then of course, as you said, the access to capital is different. But there's one area specifically where Europe can actually lead. And this is because of the high fragmentation of the market and standardization. So if you look at GSM communication, right? Here in the US, you had 4 standards, right? 4 standards for companies that propose something. ISDN, like the internet, early times of internet access, right, was a standard. And in Europe, that was all very easy, and it scaled rapidly fast. And we had 4G, like, I would say like 3 years ago, right? And everywhere, right? You can go on the subway station, you have a signal. You go through a tunnel, you have signal. Not if you drive over the Bay Bridge, right? so I mean, there are so many areas here where you wonder, how is that happening, right? This is a third world country that I don't have cell reception anymore, right? Because we Germans are so serious about everywhere and coverage, right? So if you think about standardization in M2M, there are many other areas of machine-to-machine communication, like communication between pharmacies and doctors. And that goes back to the NSA question as well. Who has your information of your health? Is the central database? Is it protected by IBM? Is it a man in the middle that handles all of that? Or is it a local doctor that then gets queried, hey, do you have any information about Thorsten? He's about to fill, a prescription. And how do you make this kind of machine-to-machine communication? There's actually a health standard out there in Europe, and it's used everywhere. And it's a huge economy. It's $1.2 trillion, if you think about that, right? So people talk about gaming aspects, right? Oh, we are in this 5, 10, 12, $20 billion market. That doesn't even count in these trillion-dollar economies. And so these kind of things in standardization are actually overlooked a lot, because people say, why should I standardize? And everyone can use it. Well, there's Intel, right? There's Motorola, Qualcomm. There are many companies that made a lot of money on standards. Open source is another example, right? You could say, hey, open source, once I open source it, right, how do I make money if everyone can implement it? Well, Google, Android, you see this happening over and over again. And I think standardization in a highly fragmented market, there's a need for standards. And that's why in Europe we see a lot of these initiatives that are driven.
Do we have another question? If not, maybe one last question from me. So you guys are the old hands on deck, or maybe your corporate VCs are the old hands on deck. There's this influx of new corporate venture capital funds. I read Anheuser-Busch has a beer garage. It's a corporate venture fund. I have yet to check it out.
Always innovation labs. They're called beer kegs.
Works for me. So what's your take of all these new kids on the block, and what's your outlook for 2014 for corporate venture capital?
I think it has been hard for the companies who arrive finally with their corporate venture in this year or last year, because the prices are high and they need to invest because they fought probably 3 or 4 years to get this going, and now they have to spend the money at a very high price. It's very hard right now for these guys. On the other hand, I think it shows that there is a model evolving, how to invest and how to interact, and I think corporates specifically learned how to play with the actual other investors and what not to do and what to do, so that's very positive. And I think this kind of community exchange in general, seeing the high number of deals and 25% of corporates, I think also makes it easier for the entrepreneurs to understand, okay, it's not like the slow guys, the bad guys, I don't have an exit guy, and that's actually very positive.
To start with the second part of the question, I think the trend will go on. More and more, also in the material space, more and more companies will set up corporate venture capital branches. I think the only caveat may be that I think a lot, if not everything, in venture capital is about relationships, is about trust, and you have to do this, I think, in a sustainable way. To do this because the others do it, and then 3 years later pull out again, I don't think it's a good idea. I think you will lose a lot of reputation, and reputation, what did Warren Buffett say, 20 years to build it up and 5 minutes to destroy it. So I think this is an important point to really, if you want to do it, you need to stay in the game for long, to build the reputation and keep it.
Sure, I think share a lot of those sentiments. It's never been easier to start a company, but it's just as hard to still build a company that is sustainable. So sort of the test will be if you're around in a couple more 4 years from now, are you still being willing to back these companies both in up and down rounds? It's easy to put money in things when valuations go up, but do you have the stomach to actually fund the company and the team that you backed on when you have to kind of go down in a valuation round? It still takes actually takes longer these days to actually exit. So if you look at this as a 7+ year journey, in some cases longer. So you need to have a stomach, and don't think that it's going to be sort of quick wins. From that point of view, I think this is going to be a little bit tricky because we had a wave in the past where people pulled out, and once things got tougher, then balance sheets and so forth was really if there's an abundance of capital, you start seeing people moving out of their normal asset class or deploying it differently. Today you cannot buy any treasury bills because it doesn't yield you any return. We see private equity companies coming down doing kind of growth stage deals. We see late stage guys doing early stage deals. So we understand that something is a little bit amiss in the current environment. So that's not specific to corporate VCs, but I think it is a symptom of sort of the entire landscape being a little bit skewed. You brought up sort of the Series B valuations is today, where Series C used to be in 2009.
Yeah, it sucks to go last on this question, because you guys have already said so much. So I'll say it can be a very good thing and a bad thing, and I'm putting myself in the seat of the entrepreneur. So from the entrepreneur's perspective, there's a lot more money available, a lot more capital available. So now it becomes a little bit easier for me to find the capital needed to start my company and potentially grow my company. Now here's where it's also a problem for the entrepreneur. If these newer corporate VCs or even new VCs, institutional VCs, if they're not well versed and educated in how to be a good venture capitalist, right? They're probably going to overvalue some of these companies. They're probably going to give these companies not so great advice, and then we'll end up in another kind of Series A crunch that we're looking at now, right? Companies were priced way higher than what they were worth back then, and are probably still, not even worth what they were priced at back then. So it's kind of a tale of two sides, I guess you could say. So I would say, if I could give advice to some of these newer corporate venture entities, it would be to really pay attention to firms like the ones up here that have been doing this for quite some time, that have seen some success, as well as some failures, and really pick up the lessons learned there, as well as when you go and you bring in your principals and your investors, do that pick folks that have been investing for some time. Don't pull someone from your R&D lab and say go be a VC, because that's probably not going to work. So
not quite a rosy forecast, but looking good for entrepreneurs.
So with that, I would thank everybody for coming tonight. We'll conclude. There is